All right, so once again, another video in terms of just understanding Chapter 5 and the time value of money. And once again, this is free. This is for you to be able to do the best that you can on your exam on May 28th and really get a better sense of how to master TVM. And we're going to break this down once again into 4 buckets. The first one being the roadmap. What are the key indicators and patterns that you need to understand here? The second bucket being the formulas. There are 5 formulas that we need to understand, and kind of like we're going to try to tie in those indicators together. The third segment will be examples. I'm going to throw at you some examples, and hopefully it'll give you a better sense of how would you use this in an exam setting. And then the fourth bucket will be just in terms of the studying process. What are the best practices to apply all of this in real time? So if we begin with the roadmap, there really are 3 subsegments here. The first one being is it a finite stream of cash flows or is it an infinite stream of cash flows? Now, if it's a finite set of cash flows, it makes it really easy for us. It makes it very simple to understand that we're dealing with annuities, and that's something that you've seen a lot throughout the course. So if it's finite, we're dealing with annuities. However, if it's infinite, if it's an infinite set of cash flows, we're dealing with what we call is a perpetuity. And a perpetuity is the easiest set of TVM formulas to understand. So it's really, really cool when you see that. So that's the first segment. Moving on to the second segment within this roadmap and within this set of patterns would be timing. This only actually occurs with finite set of cash flows. And we want to understand if those cash flows are starting at the beginning of a period or at the end of a period. And this will really be written black and white in your exam. So you don't have to worry. You don't need to, use some Egyptian archaeology type of stuff. It's really straightforward. But you want to understand if the timing is at the beginning or at the end of a period, and this will be written in black and white. Now, the last portion here for this roadmap and a set of patterns that you need to understand would be, is this a growing set of cash flows? Or is this a constant set of cash flows? Let me give you an example. We could look at your salary, for example, as being a potentially growing set of cash flows, right? Maybe every 2 years, you're going to get 20K more onto your salary. That would be nice. Or it could be a constant set of cash flows. And that could literally just be, $50 that you're going to save every single month for 20 years, all right? So that's something to understand. Now, growing and constant set of cash flows could be applied to infinite cash flows or finite cash flows. Now, that's something that we're going to look at a little bit more in detail within the second category, which is just quickly running through the 5 formulas that we have. So let's run through that second segment. Now, within this set of formulas, there really are only 5, and they're grouped into 2 categories. They're grouped, once again, throughout the annuities, and they're grouped throughout the perpetuities. Now, within annuities, all right, as I said, they could be happening or occurring at the beginning of a period or at the end of a period, okay? Now, if we have a finite set of cash flows and they're happening at the end of a period and they are constant, that's what we call a normal annuity. Now, if you look at the course pack in the formula sheet, you literally have the roadmap. So right now you should be following through and you know exactly where we're at. We're at the top right section of our course pack for our formula sheet. Now, if we're dealing with something, so we're dealing with a set of cash flows that's finite, okay? That's happening and they're constant, but now they're happening at the beginning of a period. This is what we call I'm having a blank, so we call it an annuity due, okay? And this is the same formula if you actually look into it. But we're only adding at the very end of that formula 1 plus K for the future value, because we're essentially adding an additional period in a sense. It's some black magic, but what you want to know is that when we have a finite set of cash flows that's happening at the beginning of a period and it's constant, we have what we call an annuity due. So you want to follow that roadmap once again. Now, the third and only annuity that you need to deal with is a growing annuity. And a growing annuity, once again, is something that is finite. It's a finite set of cash flows that's happening at this time at the end of a period, and it's growing. So you need to look for your K, so your interest rate, and you need to look for your growth rate because it's growing. We want to know at what rate is that set of cash flows growing. So that's kind of tying it all up for your annuities. You need to understand, well, okay, cool. We have a finite set of cash flows, and we kind of want to understand what is the timing and whether the nature of it is growing or constant. All right. Now, moving into the second subcategory here is the perpetuities. Perpetuities are easy beasts to deal with. It could literally either be a normal perpetuity, okay, so simple, or it could be a growing perpetuity. Now, this is very simple. Once again, you just need to use your formula. And when we're dealing with perpetuities, what's really cool is that we literally only need to find our present value. You can't really find the future value of a perpetuity in this sense. It's not something that you really want to do. What we're going to look into and really focus on is finding the present value of a perpetuity. And perpetuities are fun. You see this on an exam, you smile because it's really straightforward and easy. So if we move into the third segment here, examples. How would we see this on an exam? How do we understand that we're dealing with, a normal annuity or a growing perpetuity? So I'm going to throw at you a few examples, and hopefully this will give you a better sense of what we're looking at. So let's say, this is the first example. Let's say that Janet is going to invest $50 every single month at the end of that month for 20 years. What will be the amount of money Janet will have? I'm pretty sure I said the amount of years, but let's say 20 years. I'm just kind of like brainstorming here. So I'm going to give you like 10 seconds to think about it. You could pause the video in a sense, but take some time to think about it. But really what we have here is very straightforward. We have a constant set of cash flows, right? Something that Janet will be putting aside every single month, okay? It's not growing. So we know the nature here. We also know if it's finite or infinite. In this case, we know that this is a finite set of cash flows. We told you it's for 20 years, all right? And we also gave you the timing of those cash flows. We told you it's at the end of every single period. So already there, if you're using the roadmap, you found all of the three indicators that are important, and now you clearly know that, once again, finite set of cash flows, we know this is happening at the end of a period, and we know this is a constant set of cash flows, therefore we're dealing with a normal annuity. The only nuance here is figuring out whether we're trying to calculate for the present value or we're trying to calculate for the future value. In this case, because we're trying to figure out how much money you will have in the future, it's clear, it's evident that we're looking for the future value. You can't talk about future and look for present, you know what I'm saying? So this is some quick little sense checks that you should have. And in the fourth segment today, we're going to look at some best practices on how you could kind of sharpen that blade and get better at this. But anywho, let's go into a second example. All right, we're going to try to get a little bit more tricky, I guess, in a sense. So, unfortunately, your uncle passed, all right, and you happen to be in the inheritance, and your uncle is particular though. Your uncle knew that you would love the money, and that's why he put a little restriction to it. And this is what you have on the exam. And they tell you that you're going to be receiving $10,000 forever, all right? And you know that the interest rate, your discount rate or whatever your opportunity cost right now is about 7%, okay? So this is some weird stuff that you may see on your exam. And I'm going to tell you once again that you could pause. And when you're dealing with this type of set, you really want to only look for some key terms, okay? Because in this case, what you've noticed is that we didn't talk about anything related to the timing. We didn't talk anything about a beginning or an ending. We didn't talk about, you're receiving these set of cash flows at the beginning of a period or at the end of a period. We also didn't tell you if it's growing. So in this case, we could assume that it's constant. But what's really interesting is that we said the term forever. And forever rhymes with this idea of infinite. All right, so if something is forever, that's what they say in the text, or they tell you it's going to happen for an infinite set of time, we have what we call a perpetuity. And with a perpetuity, we're only really going to assess your skill to be able to compute the present value. So in this case, you're dealing with a normal perpetuity. It's a simple payment over K, and that's going to return the present value of the inheritance you expect from your uncle, right? $10,000 for forever what's your opportunity cost of 7%? It becomes very simple. You just do 10,000 divided by 0.07, and if I do some quick math, I don't know, it should be equal to, call it like between 70K and 80K, something like that, maybe 85K. I could be terrible at math, who knows. Now, that's the idea for the second example. And the third example, the one that we're going to look at, once again, kind of brainstorming, will be something that we'll work through together. On the exam, they're not going to be so nice, and they're not just going to give you a blanket statement in which you're going to have to find, the present value of a normal annuity. That's maybe one multiple choice, right? That's only going to be maybe 5% of your exam in terms of your percentage points. What they may do on an exam, what they will do actually, is that they're going to group 3 sets of formulas, 3 sets of ideas into one question. And this is when I definitely encourage you to go in the course pack and look at the literal 40 questions or like 30 questions available for you with step-by-step solutions. These questions are broken down for you step by step, and they literally tell you, okay, so this segment of the question is a normal annuity for 20 periods. Then you have the second segment of the question, all right, that's a compounding interest for 10 periods. And then the last portion of that question is a perpetuity, right? And we're going to try to assess whether you're able to find the present value of this complex set of cash flows. That's what an exam question is actually going to be like, the harder ones that are going to return maybe 12% of your grade. So that's kind of it for the examples. I don't want to spend too much time because it's ambiguous with no paper or whatever. I'm also doing this out of an iPhone at like 12:30 a.m. Now, the fourth category is just really quickly the best practices that I think you should follow through and to really help you sharpen that blade to get better here. What I would do if I were you, okay? Don't try to take the easy way out and use your calculator every single time and kind of, aim, try to find the answer aimlessly. I would really suggest that you take either the tutorials from your professors, either the course pack, either mock exams, whatever works for you, a question to practice. And then take the course pack formula sheet, and every single time you have a question, highlight the different indicators that were provided. Highlight whether it's an infinite or finite set of cash flows. Highlight whether the timing is at the beginning or at the end, okay? And highlight the nature of those cash flows. Is it growing or constant? And listen, it may happen that you have to do this like 3 or 4 times within one question. But you want to be able to do that. You want to be able to identify these sets, these problems. And once you've done that, what I did for my exam, and that's what got me really good grades, was write down the formula like a bozo every single time next to those things that you've highlighted. Write down the whole formula. The formula is what you're going to use on the exam. You have a cheat sheet. You have a formula sheet available to you. Write it down. All right. Now you've done 2 things that are going to help you have that active recall. The third element is really to do it step by step with the formula. Write down every single element that you've highlighted in the question and then find the answer. Do that every single time. It's going to be boring. It's going to take some time, but that's really the best practice here because you'll be able to be familiar with it. You'll understand, okay, well, that's my K. So that's my interest rate. That's my payment. That's my PMT. This is my N. This is the amount of years that we have. You won't get lost and confused on the nuances of the formula. And the formula is literally so easy to do. It's like what we learned in high school. Plug stuff in. So yeah, I think I'm not going to take some time to summarize what we just discussed. It's already a long video, but this is for free. It's made to help you. If I were you, look at the course back. It's free. It's literally, it's there to help you out. Maybe a few other videos to come through. Don't hesitate to reach out if you have any questions. So yeah.